Hi, Kelly. Happy to be with you. Well, this shows that the consumer, which looked to be losing a lot of steam towards the end of last year, has actually picked up steam, and really the overall economy is really accelerating. And it does harbor back to the employment report, right? So we had tremendous job gains, but also the number of hours that people were working, it increased 0.3 of an hour. So all workers working more and still seeing moderate wage gains. That means there was a lot of income for the households that was generated in January, and consumers responded. They went out spending. And this is just really the good side of the equation. There's a little bit of services here in retail sales,
Right.
but we know service activity has also been strong. So, net we're looking at real consumer spending that could be near 5% for the first quarter, and GDP growth that's 3%.
So that, which is shocking because a lot of the current estimates, we're talking about 0.5% or even declines of 0.5%. So you're kind of extrapolating this out. What happens, Kathy, if this is just filling the hole that we created in November and December?
Well, it's always tough to tell because this is, especially in the post-COVID period, not only do we have odd cross winds, but as you mentioned earlier, seasonal adjustment factors have really been thrown off quite a bit. But I think what we have seen is across the board this pickup. It's not likely to be sustainable, but it's certainly going to catch the Fed's attention. Not only is economic activity stronger, but inflation remains really sticky on the service side of the equation when you look at the super core services, right? Even when you strip out rent. So I think this means the Fed has to do more. And you're probably looking at a rate cycle that continues at least through June. And you're talking, 5.5% on the Fed funds rate, if not higher.
5.5%. Okay. People are going to start to say, look, if 5.5 is on the table, you could even start to go higher. I mean, if we don't see decelerations in the coming months. Does that really make sense to you, though, Kathy, when you look at the forward momentum, the leading indicators and all the rest of it? Can we stay in a production recession without eventually seeing employment slow down as well?
Well, our view has been that the economy was going to slow down, and that is still our view because we think one way or the other the Federal Reserve will ensure that happens because they don't want inflation pressures remain this high. But you're right. Although the manufacturing data this morning showed a rebound there as well, so and then maybe housing is starting to get at least some footing. So there's some concerns here that maybe the Fed hasn't done enough. But I think you're right. It's not. It's hard to pick the terminal rate, but we shouldn't just be doing a guessing game at that. I think maybe what's even more important for the Fed is that once they get to a certain level, they hold it there throughout for a longer period of time, right? Usually when they pause 6 months, 9 months later, they're cutting rates. This time could be different.
Well, and it wouldn't be the first thing that's a little bit weirder this time around. One final question. All of the January data has been so much stronger than expected. Is it possible that we move into February, March, and suddenly there's a big reset because maybe we don't have seasonals or warmer weather or whatever it was? I mean, do you think this 1 month is an aberration possibly?
It is certainly possible. Seasonality factors are large with employment, retail sales. And also, if you think about it, this was really touched off by strong employment gains. With an unemployment rate that's 3.4, you can't continue to churn out 500,000 new jobs each month unless we get this big resurgence in labor supply. And that doesn't seem likely.
Right. It's literally mathematically impossible at some point. We just didn't think it was going to be the supply side slowing things. Kathy, thank you. We appreciate it. Kathy Bostjancic.